Hey everybody, G. Kelly Dixon here. So right now we're doing our financial literacy week, and I'm just dropping crazy knowledge on you about banks, about loans, things that a lot of people don't know and understand. Even people that own homes, even investors that have been in the game for years, don't fully understand what I'm about to show you right now. So right now we're going to talk about amortization and what you need to know before you take a loan. Let's go. We're going to study this thing, amortization, and I'm not going to give you a very technical definition. Here's what I'm going to say, okay? Amortization basically refers to the schedule of payments that you have in order to pay back a loan. So the first element of amortization is time. So how long are you going to how long are you going to take to pay back the loan? So when you get a mortgage, you can go a 10-year, 15-year, 20-year, 25-year, 30 years. You may hear the term 30-year amortization. What that means is you're taking 30 years in order to pay back a loan. Okay, great. Now we have that part out. So the first element of amortization is time. How long are you going to take in order to pay back the debt? The second element of amortization is the interest rate. If you're borrowing money from a bank, typically you have an interest rate. So we're going to do this example right now, and I want you guys to pay close attention to this. So let's say we have a house, and we're going to buy this house for $300,000. And let's just say we have a very friendly bank, okay? And this bank goes, we will loan you $300,000 and we want no interest. That is a 0% interest rate. So basically, they're saying that over the course of 30 years or 360 payments, okay, there's 12 payments to a year times 30, it's 360 payments. We're going to allow you to pay back this house, and we're not going to charge you any interest. So if we take 300,000 and we divide that by 360, we're basically going to get $833.33. So if we were to make that payment over the course of 30 years with a 0% interest rate, we would have paid off the house. Right? Got it. Cool. Now, unfortunately, amortization is a little bit more complicated than that, right? If you have any banks that are lending money at 0%, please share that information with me right now. I'll be your best friend for years. Trust me. They don't exist, right? So, let's look at it a different way now. So, we have this interest rate that we're going to get. Okay, so if we take this $300,000, and let's say we have a 5% interest rate. And let's say there is no amortization right now. Let's just say we're paying interest only. So what does interest only really mean? Interest only means that I'm not paying down the principal at all. All I'm paying is the interest on the loan. So at $300,000, the interest rate for the year, the interest for the year would be $15,000, right? So we take 300,000 times 5% or 0.05, however you want to do it, and we would get 15,000 for the year, or we divide that by 12, it'd be $1,250 per month. So if we paid $1,250 per month, we would cover the interest on the property. Okay, and that is absolutely paying down no interest, no principal at all. That is just paying the interest on the loan. That's it. Okay, so the question is, how, after 30 years with the interest only payment, how much do we owe the bank if we bought the property for $300,000? At the end of 30 years, we would owe the bank $300,000. The only thing that we've paid is the interest. Okay? Are you following me so far? Very good. It's going to get a little complicated now, so I want you to pay close attention. We have this weird thing where amortization combines time, right? Because we are going to pay down the principal in our payment, and we're going to also pay interest, right? So if we did the interest only payment, and that was $1,250, and we did the amortization period, which was $833. Okay, if we combine both of those, right, we'd be at 2,000 and change, right? Or I forget the exact number. It's it'll come back to me. I think it was like roughly what 2180. Yeah, I think it's 2083 or something like that, or 2183, something like that. Right, a little over $2,000 would be our payment. I think it was 2083.33 would be our payment, right? If we had to pay the interest and the principal at the same time, right? So the thing is that would be very high actually, because we're not really paying. We can't pay interest on things that we've paid back already. Okay, so let me explain this. I want you to pay close attention. If we have a payment that includes interest and principal, right? So the first payment would technically be the $1,250, right? Because we're borrowing that money, and it would be the $833. 30 plus the 833.33, right? For a total of $2,083.33. So after we make that payment, though, we're not borrowing the $833.33 anymore, right? Because we paid it back. But they can't charge us interest on that $833.33 anymore because we paid it back. So because we paid it back, that $1,250 or $1,250 payment would actually have to decrease a little bit, because we paid back a portion of the principal and we're no longer borrowing it. So they can't continue to charge us interest on it. So technically, we only borrowed it a month, right? So with every payment, it would gradually get lower, because it's money that we're not borrowing. So our payments would start very high, and then they would, over the course of time, become lower, right? So if you look at this, and I'm gonna look at this on a yearly basis. So let's just say the first year, let's just say our payments were annual. Okay, we got a loan and we have to make a payment to each year, right? So we look at this on an interest level. Our first year, we borrowed $300,000. We paid $15,000 in interest, and let's say we paid down some of the principal as well. So at the second year, I think we're at $10,000 a year. Right, so our second year, now we're paying interest on $290,000, hypothetically, right? So that the amount of interest we would pay actually goes down. So that would actually drop to $14,500 that we're paying interest on that year. And let's say we pay another $10,000 principal. The third year, it would drop again to 5%, drop another $10,000, and then we take 5% of that, and then that's what we're borrowing year three. So it would continue to go like that until the interest that we're paying eventually hits nil, right? Which would be the last payment. Rather than have this wide range of payments starting here and ending here, what amortization does is it balances everything out. So we did part one. I'm going to pause here because you guys got a lot to think about. Father, stay tuned to see how this works again. Tomorrow, I'm going to show you which of these loans you should be taking and how to pay down and pay off your house and your investments super fast. Part 2 tomorrow.